Welcome to the Financial Institutions and Monetary Policy Subcommittee for the 118th Congress. This hearing is entitled Revamping and Revitalizing Banking in the 21st Century. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. I now recognize myself for 5 minutes to deliver an opening statement. Thank you to our witnesses for joining us today for the first hearing of the Financial Institutions and Monetary Policy Subcommittee in this session of Congress. Today's hearing will examine areas where banking regulations can be updated to align with existing and emerging technologies, barriers to entry for de novo banks, and impacts on competition in community banking, the current framework governing consumer data privacy, and transparency and accountability in bank regulation and supervision. For years, I've been raising the alarm and pushing for regulatory changes to address the crisis of de novo bank charters. According to the FDIC, only 60 new banks have been chartered in the past decade. In contrast, more than 2,000 banks were formed from 1990 to 2008. Obviously, this is a trend that we need to examine. In addition to fewer new banks, there's also been a growing trend of community banks merging, being acquired, or simply closing their doors, which has accelerated following the financial crisis. While low interest rates and a weak economy may have contributed to this decline over the past decade, we also know these trends are caused by a number of factors, including cost, compliance, and regulatory burden. Congress should be encouraging an economic and regulatory environment that allows community financial institutions to thrive, let alone survive. My bill, the Promoting Access to Capital in Underbanked Communities Act, seeks to increase de novo bank formations through a reduction in burdensome initial capital requirements and restrictions. A bill sponsored by Representative Auchincloss directs the federal banking agencies to study and report to Congress on ways to promote the establishment of new banks and credit unions, including community development financial institutions, CDFIs, and minority financial institutions. These bills are steps toward identifying and addressing the challenges posed to the chartering of new financial institutions. The fact is, encouraging the establishment of de novo financial institutions will help fill the needs left by a drought of new community financial institutions, along with consolidation and closures over the past decade. Enabling new bank formation will increase banking options and competition to better serve families, small businesses, farms, and local communities. We will also be discussing bills sponsored by Representative Williams and Representative Foster that encourage coordination of state banking agencies and federal banking agencies in regulating and examining the activities of bank service companies, and prevent the Financial Stability Oversight Council from voting to determine that a non-bank financial company will be supervised by the Federal Reserve without first considering alternatives. These bipartisan bills are first steps toward clearly demonstrating Congress's intent when it comes to transparency and accountability in financial regulation and supervision. Technology has fundamentally changed the way consumers participate in our financial system, both by improving access and inclusion. It has also increased the amount of sensitive data shared with service providers and the government. Our privacy laws, especially as they relate to consumers' financial data, must keep up. The financial services industry is already highly regulated with regard to consumer financial information disclosed under the Gramm-Leach-Bliley Act. However, the ways in which consumer data is collected and disclosed has changed dramatically in the past 20 years, due primarily to the proliferation of new technologies that consumers interact with on a daily basis. It is time for Congress to update the protections in GLBA to bring our regulations into better alignment with existing and emerging technologies. The discussion draft we're discussing in this hearing is intended to modernize the Gramm-Leach-Bliley Act using a technology-agnostic approach, put control back in the hands of the consumer, protect against the misuse or overuse of consumer non-public personal information, empower consumers by requiring privacy terms and conditions to be transparent and easily understandable, and provide a national standard for data privacy, thereby reducing compliance burdens and providing certainty to both consumers and entities that handle their financial data on a uniform basis nationwide. I look forward to continuing to work with my colleagues on this discussion draft to secure Americans' privacy without strangling innovation. The chair now recognizes the ranking member of the Subcommittee on Financial Institutions and Monetary Policy, the gentleman from Illinois. I congratulate my friend from Illinois for his position as ranking member of the subcommittee. I look forward to working with him in a bipartisan way. Dr. Foster, for 4 minutes for an opening statement.
Well, thank you, and congratulations yourself, Chair Barr. It has been, for me, an interesting journey. I took office for the first time in March of 2008 and was down in the front rows there during the financial crisis. I was reading Kindleberger and in the weeks before Lehman fell, and decided I would actually finish reading it over the weekend after that happened. And so I think it's the most important thing we need to have in this committee generally, in this subcommittee in particular, is a complete and correct understanding of history. Because, I will be distributing a picture that sort of encapsulates that. This is simply a history of bank failures in the United States from 1864 until the financial crisis, basically. And it's interesting to look at the general picture of this, that you see, first off, that you see prior to the 1930s, bank failures were very common. You know, they just happened almost on a weekly basis. And then there was a crescendo of them in the 1920s and 1930s. And then we passed the FDIC bill and Glass-Steagall and so on, and boom, they went to zero for about 40 years, near zero for 40 years. And then we had a burst of deregulation in the 1980s and were rewarded by the savings and loan crisis, which is not something that's on a lot of our consciousness at this point. But in fact, the taxpayer paid something like 1.7% of GDP, dead loss to the taxpayers because of the savings and loan crisis, which was not a failure of a few giant banks. It was a failure of thousands of small banks that were, in retrospect, underregulated and got on the wrong side of some interest rate bets and some rather corrupt practices in some case. And then, so then we put that behind us and then had another wave of deregulation in the early 2000s and of course paid the price tremendously in the financial collapse. And so our first goal, our prime directive in this subcommittee is we do not want to be having hearings on the next wave of bank failures and collapses. And we have to understand the importance of proper regulation in that. The second thing is just generally the merit of regulation, and I will also be distributing this table. This is a table that I made, probably a decade ago, almost maybe 2015, I think. It was simply a list of all the failures, the giant failures, bailouts and bankruptcies of giant businesses, most of them financial businesses. And at the time I made this, I don't think the list has changed significantly. You know, at the top, of course, it's Fannie and Freddie, Lehman Brothers, Washington Mutual. These are just sorted by the assets at failure. And behind every one of these failures is grief for thousands of American families. You know, the employees of Enron suffered tremendously because there was not proper regulation of Enron. And just you go down this list, Continental Illinois Bank and Trust is still remembered in my state of Illinois as something that, interestingly, of the top 16 largest firms by assets at failure, every one of them happened under Republican watch. And I think that's significant. So we have to be careful not to just follow the traditional, partisan split on this and repeat mistakes that were important in the past, because when giant businesses fail, it's not just Wall Street that suffers. It's ordinary families, and we have to understand that. Anyway, there's also a lot of issues. I want to thank the witnesses for their written testimony, because it represents the full spread of issues that we have been and will be and should be discussing on this. And I just want to touch on one thing, preemption, that there's a long list of issues that, you know, some people argue for a federal floor, a federal ceiling, a federal standard. Other institutions love the idea that we have 50 different standards because they enjoy it as a barrier to entry to new competitors. And so the idea that I want to throw out there as an area of potential compromise on this is the idea that any group of representing 20% of the states should be able to get together and adopt a common standard so that new entries would only have a handful of standards instead of 50 different or a single one-size-fits-all. And anyway, thank you, Mr. Chair, and
Thank
look
you.
forward to working.
Thank you to the ranking member. And finally, the chair recognizes the ranking member of the committee, the gentlewoman from California, Ms. Waters, for 1 minute.
Thank you, Chairman Barr. I'm very pleased we're considering reforming the banking sector because consumers are sick and tired of banks ripping them off, saddling them with junk fees, and otherwise engaging in abusive and illegal behavior. Similarly, I look forward to reviewing Chairman McHenry's bill on data privacy, which is something that should be strengthened, but the details matter, and I understand consumer advocates have already raised serious questions. Additionally, Dodd-Frank has been lauded for preventing a financial crisis when the pandemic struck. We should now be wary of deregulating our way into another financial crisis. Finally, Republicans must end their brinkmanship around whether the U.S. can pay its debts. Otherwise, any reforms to the banking industry passed by this committee will be undone when our markets collapse. I yield back the balance of my time.
Thank you, Madam Chair, and I look forward to the robust discussion about whether deregulation or government policy was responsible for many of these financial crises. Today, we welcome the testimony of Mr. John Burlaw. Mr. Burlaw's work focuses on how public policy affects access to capital, entrepreneurship, and investments made by the public and business community alike. He has also studied the consequences of financial reform efforts passed by Congress, like the Sarbanes-Oxley Act, and the government's response to the 2008 financial crisis, including the Dodd-Frank Act. Mr. Brian Knight. Mr. Knight's research focuses on numerous aspects of financial regulation, including the creation of pro-innovation regulatory environments, the role of federalism in fintech regulation, the use of digital assets for financial transactions, the role of regulation for credit markets and consumer protection, and the provision of capital to businesses. Mrs. Penny Lee. Ms. Lee previously served as Chief Strategy Officer of 1776, a prominent technology incubator and accelerator servicing over 1,200 startups. She also co-founded a Washington, D.C.-based angel investment group, K Street Capital, and can provide insights on how our regulations affect innovation and new technologies. Mr. Jim Reuter has extensive banking experience, starting his career at First Bank in 1987 and holding several different roles within the organization. First Bank has attributed many of the bank's products and IT innovations over the years to Reuter's leadership and guidance. Mrs. Renita Marcellin. Ms. Marcellin is the Advocacy and Legislative Director with Americans for Financial Reform. She previously served as Senior Associate at J.P. Morgan Chase, where she worked to strengthen the bank's anti-money laundering controls. We thank each of you for taking time to be here. Each of you will be recognized for 5 minutes to give an oral presentation of your testimony. Without objection, each of your written statements will be made part of the record. Mr. Burlaw, you are now recognized for 5 minutes for your oral remarks.
Thank you. Thank you, Chairman Barr, Ranking Member Foster, and honorable members of the subcommittee. Thank you all for this opportunity to present testimony on behalf of my organization, the Competitive Enterprise Institute, at this hearing on the vital topics of financial inclusion and financial innovation, and on the regulatory barriers preventing the formation of new banks that could be a vital part of reaching consumers and small businesses that aren't being served adequately by the existing financial system. CEI is a Washington-based free market think tank founded in 1984 that studies the effects of regulations on job growth and economic well-being. Now, as competitive is the first word in our name, we are also very concerned about the extraordinary regulatory barriers that have been erected since the financial crisis of 2008 to the formation of new or de novo banks. In every business sector, new entrants are essential to the functioning of a competitive free market economy, the creation of jobs, and spurring innovation. Now, when we hear terms like innovation in regard to any business sector, we often think of things like apps, digital wallets, and artificial intelligence, all of which are great things. But all innovation really means in financial services and other businesses is creating a better way to serve existing customers and bring in new business. So with that example, I think it's worth looking at what one de novo bank did to better serve its customers, involving machines more associated with 19th century, like horses and buggies. The Bank of Bird in Hand became a de novo bank in 2013, and it was serving the Amish community in rural Pennsylvania. And one of the things it did was make it drive-through lanes accessible to horses and buggies, build a shelter, a barn-like shelter for the horses, mobile banking units that could come to some of the farm communities for those who couldn't make the trek with a horse and buggy. And this is an example of the kind of innovation a de novo bank can do. But unfortunately, Bird in Hand was the first de novo bank chartered in more than 3 years by the FDIC, and only a handful have been given approval, given the green light since then. Whereas by contrast, in pretty much all of the decades before, even right after the S&L crisis, the FDIC would approve more than 100 de novo banks per year. So, no doubt there was more than one factor in the stunning drop in the number of new banks per year, including the costly provisions of Dodd-Frank, which imposed a crushing burden on many existing community banks and credit unions. But there was also a new FDIC policy that required de novo banks to put up really a massive amount, like 7 years worth all at once, of upfront capital. So that if a de novo bank or people who were trying to organize it thought that maybe it would have $500 million in assets in 7 years, it would have to come up with $40 million right at the time. So, in areas, in underserved areas where there aren't, venture capitalists falling out of trees, that can be sort of a hard thing to do. So it was sort of like the FDIC was hanging a sign that said no new banks need apply. And though things have improved, the policy's been modified somewhat as far as upfront capital. It still, doesn't compare to even the decades before, even after the years after the S&L crisis. Now, unduly restricting the emergence of de novo banks may be justified by some as preventing risk, yet the practice poses its own risks. A lack of new entrants in the banking sector increases the chances that a large bank failure could severely curtail the supply of credit and availability of financial services, and that in turn sets the stage for a continuing cycle of government bailout and increases a demand for it. A competitive market free of heavy-handed regulation enables a financial system and an economy that is simultaneously dynamic, inclusive, and resilient. Thank you again for inviting me to testify, and I look forward to your questions.
Thank you, Mr. Burlaw. And now, Mr. Knight, you are now recognized for 5 minutes to give your oral remarks.
Thank you. Good morning, Chairman Barr, Ranking Member Foster, and members of the Subcommittee on Financial Institutions and Monetary Policy. It's an honor to testify before you. My name is Brian Knight, and I'm the Director and a Senior Research Fellow for the Program on Innovation and Governance at the Mercatus Center at George Mason University. Any opinions I express today are my own and do not necessarily reflect those of my employer. I intend to discuss the following key themes: collaboration, accountability, and Congress's role. The business of banking is changing, in large part due to technology. For example, the merger of two large banks, BB&T and SunTrust, into Truist, was justified in large part by the need to achieve scale so that they could afford to produce the technology necessary to compete. An average community bank is unlikely to merge its way to the scale of Truist. So what can they do? And one important option is to partner with innovative service providers that can leverage technology beyond what the average community bank can develop internally. This technology can assist with a range of functions, including customer acquisition, intake, and underwriting. These technological innovations can provide better service. The use of alternative data has been shown to provide better pricing for borrowers with limited credit histories. Fintech firms have increased the availability of credit to relatively underserved markets. And for example, there's evidence that during the Paycheck Protection Program, Fintech enabled loans to be extended at higher rates to the smallest businesses, minority-owned businesses, and businesses without a pre-existing relationship to a lender. Now, nothing is perfect. For example, some fintech lenders have been identified as having significantly higher fraud rates on their PPP loans. Even here, though, the value of the bank partnership is apparent. As per a congressional report, some bank partners were able to insist upon improved due diligence and compliance with their fintech partners, likely lowering the rate of fraud. Small banks will be better able to compete if they can partner with other firms. Unfortunately, unwarranted or inapt regulation imperil the value of bank partnerships. While some regulation of these relationships is entirely appropriate, we must be certain it's not excessive or unfairly penalizes smaller banks. This brings me to my next point. The relationship between government and banks is unique. Banks are regulated in a more intimate and intense manner than almost any other industry. Banks are subject to ongoing supervision that results in regulators exercising power and discretion outside the view of the public and leave banks feeling like they are bound by nominally non-binding guidance and are loath to challenge their regulators in court. Unfortunately, there is evidence that this dynamic has resulted in past abuses where regulators have de facto punished banks for engaging in illegal but disfavored activity. The most notable examples are the efforts of FDIC employees to prevent banks from offering refund anticipation loans or working with payday lenders. In both cases, regulators frequently could not rely on a violation of law or some other objective criteria, and instead relied on nebulous concepts like reputation risk as justification to threaten and penalize banks for engaging in lawful business. While the FDIC has since disclaimed the aggressive acts of some of its employees, there's been no concrete legal change. Likewise, while some courts limit the concept of unsafe and unsound to require a concrete threat to a bank's stability, regulators and some other courts do not recognize this limitation. It's critical that bank regulation be transparent, accountable, and consistent with the law and Constitution. To be clear, I don't think that most regulators are inherently malicious. Rather, the nature of the regulatory system creates poor incentives for all involved. Congress can and should help address these problems. The first thing Congress should do is engage in vigorous oversight. Congress should engage fully with the regulators and with regulated entities to get more insight into how regulators use their power. The second thing Congress should do is ensure that regulators' material supervisory decisions can be appealed to a truly neutral third party. Third, Congress should provide more clarity as to the scope of a regulator's authority. At a minimum, Congress should make clear that for something to be an unsafe or unsound practice, there must be a concrete rather than speculative harm, and that harm must pose a significant risk to the bank's financial condition, not just mere potential lost profit. Congress should also consider eliminating things like reputational risk from the regulator's purview in favor of more objective criteria. Small banks are an important part of the American economy. Congress and regulators should foster an environment that enables innovation, as well as clarify the scope of regulators' authority to make bank regulation more transparent, objective, and resistant to abuse. Thank you again for the opportunity to testify. I look forward to your questions.
Thank you, Mr. Knight. And Ms. Lee, you are now recognized for 5 minutes to give your oral remarks.
Thank you, Chairman Barr, Ranking Member Foster, and members of the subcommittee for the opportunity to testify today on this important and timely topic. My name is Penny Lee, and I am President and CEO of the Financial Technology Association. We are a relatively new trade group representing the industry leaders shaping the future of finance. We champion the power of technology-centered financial services and believe in a world where everyone, anywhere, can access the financial products they need to succeed. Digital tools are putting people in control of their finances and making it easier and cheaper to move, save, manage, keep, and invest their money. Our members are the innovators, helping aspiring entrepreneurs in every zip code access the capital and resources they need to start a small business. From selling products on an e-commerce marketplace to helping them make payments, reach customers, manage payroll, and track costs more efficiently. Millions of small businesses are powered by Fintech, from your local florist to your neighborhood restaurant. Financial technology helps college students purchase books or supplies for the next semester in a way that better fits their budget. It allows families to send money overseas to loved ones more quickly, safely, and cheaply, and helps all of us get our dinner delivered and have the driver paid as well in real time. These financial digital tools help people keep their money while also saving them time. According to a recent survey by the Harris Poll, 8 in 10 Americans used Fintech to manage their money in 2022. and 93% said they benefited from it. Consumers used to primarily conduct their financial business in a bank branch. Today, they expect to manage their finances on their mobile phone or via the internet. Therefore, it is critical that the statutory and regulatory framework that apply to financial services keep pace and modernize accordingly. FTA and its members believe that consumer choice, trust, and protection are the cornerstones of financial services and support efforts to modernize financial data privacy expectations and create a clear, consistent, and uniform federal privacy standard that preempts the patchwork of state privacy laws while satisfying consumer needs and expectations, safeguarding consumer data, and supporting broader societal objectives and other legal requirements. In particular, modernizing federal privacy laws like GLBA will help ensure a level playing field for all financial services participants, enhance consumer rights, and ensure that privacy and security standards fit the digital age. We appreciate Chairman McHenry, Chairman Barr, and the committee's efforts in this space. Last year, we released data privacy principles adopted by all of our members, and they include the following. Consumers should control their personal data. Information provided to consumers should be clear and transparent. Consumer data should only be collected for stated and transparent purposes. It should be protected and informed by leading security practices. Consumer data should not be used in a discriminatory manner, and consumers should not fear retaliation for exercising their rights. We believe these principles should inform any financial data privacy modernization effort. Proper use of consumer financial data is the future and will underpin a more fair, accessible, and inclusive financial system capable of better serving all Americans, American consumers, and small businesses. On behalf of FTA's 22 member companies, I appreciate the opportunity to engage with the subcommittee today on modernizing federal financial data privacy requirements and other efforts. Fintech innovations are driving competition, enabling access, empowering choice for consumers and small businesses that result in lower cost, enhanced convenience, and strong financial futures. We believe that today's digital infrastructure enables consumers to plan and shape their financial tomorrow. To that end, we support policy efforts that prioritize regulatory frameworks that spur innovation while safeguarding consumers, and look forward to working with the subcommittee and other members on this important matter. Thank you.
Thank you, Ms. Lee. And now, Mr. Reuter, you are recognized for 5 minutes to give your oral remarks.
Thank you. Chairman Barr, Ranking Member Foster, and members of the subcommittee, thank you for the opportunity to testify today on revamping and revitalizing banking in the 21st century. I've been fortunate enough to testify before this subcommittee in the past, and I look forward to once again sharing my perspectives of a banker over 35 years on changes underway in our industry. Today I'm speaking on behalf of Denver-based First Bank and our 3,000 employees, as well as the American Bankers Association, whose members include small, mid-sized, regional, and large banks who together employ more than 2 million people. Founded in 1963, First Bank has grown organically to more than 100 locations in Colorado, Arizona, and California. We are currently the largest headquartered bank in Colorado. While our business is banking, and everyone who works at First Bank understands the commitment to the communities we serve. For example, our 300 bank officers sit on 2 to 3 nonprofit boards each, bringing support and leadership to hundreds of nonprofits. Further, our most recent Colorado Gives Day raised over $53 million for more than 3,000 nonprofits in just 24 hours. That commitment also goes to the services we provide our customers. Our motto is to meet our customers where, when, and how they want to be met. That meant offering mobile banking before many others, as well as being an early adopter of instant payment services before others. That, coupled with our Banking for Good mission, is what has enabled First Bank to be a successful community bank. I'd also like to take a moment to reflect on the banking industry over the last several years. During the COVID-19 pandemic, banks were a source of strength to the country, providing critical financial support for the economy in a time of uncertainty and stress, all the while maintaining near-record capital levels despite the economic disruption. We come here today with a healthy, robust banking industry continuing to meet the needs of Americans. However, like many industries in this country, we face challenges from uncertain economic and business conditions, and despite that, we expect to remain strong and resilient going forward. While my comments today will address the several bills being discussed as part of the hearing, I would also like to note that the ABA has outlined in its Blueprint for Growth additional legislative and regulatory steps which we believe policymakers, such as yourselves, can take to support a dynamic and innovating banking industry and help foster a competitive financial services market. Of the several bills of interest to the committee today, Chairman Barr and Representative Auchincloss proposals would help promote de novo charters, increasing availability of banking and financial services. I will also discuss Chairman McHenry's draft legislation on data privacy. ABA has long supported efforts to promote the formation of new banks in urban and rural areas, and our industry has always welcomed competition. In the face of consolidation, new entrants bring new vitality to the industry while expanding banking access for both individuals and small and medium-sized businesses in the communities they serve. Among other provisions, Chairman Barr's legislation would establish a 3-year phase-in period for new banks to comply with capital standards, a reasonable and temporary regulatory adjustment that will encourage de novo formation of banks that will be well-equipped to serve and respond to the pressing banking and financial needs of their local communities. ABA strongly supports this legislation. Representative Auchincloss's legislation requires federal banking agencies to undertake a long overdue study to report on the challenges faced by entities attempting to become de novo institutions and to develop a strategic plan to assist in the de novo application process. ABA also supports this legislation. As to Chairman McHenry's efforts to modernize financial data privacy laws, ABA supports several aspects of the draft and will continue working with the committee to ensure any final legislation implements any new privacy rights in a thoughtful manner. ABA supports the addition of meaningful preemption and additional clarity about the application of the Gramm-Leach-Bliley Act to data aggregators. As the committee continues its effort, we recommend that any legislation include comprehensive preemption of state law, not add a private right of action or enforcement by state attorneys general, preserve the GLBA's administrative enforcement structure by the prudential regulatory agencies, and ensure that any new privacy rights do not impair or interrupt the operation of the financial system, impose undue compliance burdens on banks, and provide real value to consumers like the approach taken by Congress when the GLB was initially adopted. Thank you for the opportunity to testify, and I look forward to answering your questions.
Thank you very much. And Ms. Marcellin, you are now recognized for 5 minutes to give your opening remarks.
Chairman Barr and Ranking Member Foster and Ranking Member Waters, thank you for the opportunity to speak on behalf of my organization, Americans for Financial Reform, an advocacy and coalition group that was instrumental in passing the Dodd-Frank Wall Street Reform Act. It is our mission to maintain its reforms and advocate for proposals that further strengthen our financial system. Unfortunately, many of the proposals being discussed today take us backward on the path to creating a more fair banking system that works for working class communities, like the one I grew up in East Flatbush, Brooklyn, New York. A fairer financial system has strong safeguards for consumers' financial data, stops excessive corporate power in its tracks and promotes competition, and applies the same rules to the same activities that bear similar risk, regardless of the technology used. First, I would like to lay out principles for protecting people's financial data. 1, our financial data laws should not be amended to preempt state laws, especially when the federal legislation proposed is weaker than the protections currently provided by many states, including California and Illinois. 2, it must include a strong private right of action for consumers to seek recourse when harmed by a violation. 3, it must affirm the role of the Consumer Financial Protection Bureau, the agency tasked with protecting consumers and their right to access their own data from a financial services business in regards to products and services they use. The CFPB is currently writing rules to give consumers control over their data. Congress should be supporting this and not undermining them. The proposed financial data privacy bill before us today does none of these things. We cannot afford to roll back protections for consumers that safeguard their data, especially as we enter this new age of banking that is more and more defined by the blending of two behemoth industries, Wall Street and Silicon Valley, the latter of which depends on a business model of data maximization. We see the intertwining of these industries manifest in numerous ways, including digital wallets and peer-to-peer payments via platforms like Venmo. Last week, Twitter announced they are working to offer payment services across their platform. What happens when Twitter combines their data on where we eat, shop, and sleep with transactional data? Large tech companies also have the ability to offer a full suite of banking services while avoiding the necessary banking rules by obtaining an industrial loan company charter. AFR, consumer advocates, and even bank trade groups have long sought to close this loophole. The rise of buy now, pay later products is another example of tech and financial services blurring their boundaries. These products that effectively offer credit often rely on the expectation of late fees, can be difficult for people to manage, and can trigger non-sufficient fund fees if linked to a bank account. Also, they lack the same dispute or refund rights that credit cards have and can negatively affect your credit score, even if you pay them all on time. Lastly, many partnerships between bank and fintech firms have created a backdoor for predatory lenders to exploit vulnerable consumers, including veterans and communities of color, by offering loans with APRs in the triple digits. Given the various ways big tech now offers financial services, Congress should work to make our traditional banking system more resilient, in addition to protecting consumers' data. In that vein, Congress should resist the urge to roll back capital requirements for new or de novo banks, as they are called. Banks need an adequate capital cushion to absorb their losses during times of stress. We learned this lesson in 2008 and should not forget it in 2023. If we are serious about injecting competition into the banking landscape, Congress should amplify calls to bolster our bank merger review guidelines so new banks don't have to compete with larger and larger banks. If we want more banks, we should not make it so easy for them to merge. In conclusion, innovation is not a reason to forget proper regulation. Consumer protections, prudential regulation, and anti-monopoly laws came after hard-learned lessons in American history. To create a banking system worthy of the 21st century, we should build upon these lessons instead of tearing them down. Thank you.
Thank you, Ms. Marcellin. And before we turn to member questions, I would ask for unanimous consent to enter Chairman McHenry's opening statement into the record. So ordered. The chair now recognizes himself for 5 minutes for questioning. And I'll start with Ms. Lee and the data privacy issue. The financial services industry, as I said in my opening statement, is already a very highly regulated sector when it comes to privacy. However, since GLBA was enacted, we have seen a proliferation of innovation in the financial services space, requiring the need to update and modernize that law. As we look to make those updates, deciding on the proper enforcement mechanism is extremely important. Ms. Lee, do you have an opinion on what enforcement mechanism would be best for the financial services industry? And I say that with reference to Mr. Reuter's view about private right of action being not the right answer.
Well, thank you, Chairman Barr. And you know, it is something that we have been in discussions with. We know this is a relatively new draft, and so what we would love to do is come back. We know that there is trade-offs on either side. We know that there's a private right to action. We know there's state attorney general's actions. There's federal enforcements and other things. And we would love to work with this committee on talking through kind of the pros and the consequences of various different enforcement acts. But we believe that this, however we modernize it, that it does need to have some type of strong enforcement mechanism to ensure that the consumer's data is protected for all means.
Mr. Reuter, would a private right of action affect innovation? Would it open the door for frivolous lawsuits from trial lawyers?
Chairman Barr, I think it would open up for frivolous lawsuits. The thing I would point to is banks have been in the data industry for a long time, and GLBA has been around for 20 years. And I think if you look at our track record, it's really good. And so as a result, I think something that's very important is preemption to state law, because I have customers in all 50 states, even though I'm headquartered in Colorado. And then two, I think having the prudential regulators being the one that's overseeing enforcement has proven to work well. As banks We have everything that we could ever possibly know about a customer, but we're in the trust business. And the way we make money is we gather deposits and we make loans. And so I think we've acted very responsibly with the data, and GLBA has stood this test of time.
As I mentioned in my opening statement, since the financial crisis, de novo charter formation has significantly slowed. Between 2010 and 2019, fewer than 10 new banks opened on average per year. And burdensome regulations and other roadblocks have reduced de novo community bank formation, denying individuals and business access to banking services. This is one of the reasons why we have the necessity for these mergers. My bill, the Promoting Access to Capital in Underbanked Communities Act, is relatively straightforward, allowing for a phase-in of capital for de novo institutions, including some provisions targeted towards underserved rural areas and several other common-sense provisions to promote bank access in unbanked communities. Mr. Burlaw, can you please discuss the impact of bank consolidation in rural communities, and will increased de novo bank formation help solve the problem?
Don't know that de novo bank, that consolidation itself is necessarily a bad thing. That, as Mr. Knight said, that sometimes mergers can provide more efficiencies, more services to consumers. What my issue is with consolidation, driven by the cost of regulation, and also in the case of Bird in Hand and other banks, some of these communities were never really adequately served, and that's what you really need de novo banks for, and that's the good that your bill and Congressman Auchincloss's bill would do as far as phased-in capital, studying the situation for de novo and what are the barriers and other things.
Well, back to Mr. Reuter and Mr. Knight, perhaps. I believe that community banks are what sets our country apart from many other financial services markets around the world. If you go to Europe, you have large banks, and if you go other parts of the world, it's large institutions. We don't have, they don't have community financial institutions like we do, and that is essential to new business formation and entrepreneurship, relationship banking, lending to someone based on their character, risk-taking. That creates the dynamism of our economy that sets us apart and helps U.S. competitiveness, in my view. Mr. Reuter, in your testimony, you note that my bill that would spur more de novo bank formation, that would increase competition, expand banking access for small businesses. Can you elaborate on that? And do you agree with that argument of competitiveness with small community banks?
I strongly agree with that argument. We are a great example of a community bank. We have, as I mentioned in my opening comments, 300 officers that serve on 2 or 3 nonprofits each. It's not just the nonprofits that benefit, it's all the businesses that are associated with those nonprofits. We raised $53 million for over 3,000 nonprofits in 24 hours. Having a group of people on the ground, 300 officers living in the communities, using the businesses, there's no better way to have a pulse on what that community needs. So we're all for more competition. Bring it on.
Thank you. My time has expired, and the chair now recognizes the ranking member for I'm going to actually recognize the ranking member of the full committee first, I believe. The gentlewoman from California, Ms. Waters, is now recognized.
Thank you very much, Mr. Chairman. I would like to direct my question to Ms. Marcelin. We're talking about revamping banking at this hearing, and I think this is the perfect opportunity to talk about complaints from consumers who have been repeatedly ripped off by megabanks. In December, the CFPB slapped Wells Fargo with an order to pay $3.7 billion in fines and compensation to harmed consumers. I was pleased Director Chopra said that fine, large as it may be, was just a first step, and that he would work with banking regulators to consider imposing even stronger restrictions on the bank. Ms. Marcelin, do you agree that far too many financial institutions, fines are just the cost of doing business, and that our regulators should do more to impose tougher penalties to curb the illegal and abusive actions of megabanks?
Thank you, Ranking Member Waters, for that question. Yes, I absolutely agree. Companies like Wells Fargo, as you said, repeatedly break the law, pretty much in the news almost every quarter, from their fake account scandal to forged documents where they used to illegally repossess people's homes, just to name a few. I will turn to Acting Comptroller Sue's speech recently, where he said, there are things that regulators can do involving even going as far as revoking their charter, their national charter, or using a consent order, for example, to stopping them from getting new business. And we think that the regulators should be using all of these tools, even when using stress tests, for example, and getting that back to being a supervisory tool. However, Comptroller Sue said it, but we are waiting to see regulators use their power to the full extent of the law.
Thank you very much. Ms. Marcelin, in my bill, the Repeat Offenders, Megabanks, and Credit Bureaus Accountability Act, financial regulators are required to draw up a plan for how they will use their authority to curb repeat offenses of large financial institutions. Recently, Acting Comptroller Sue outlined the first draft of an escalation plan where regulators would impose tougher penalties, including breaking up a bank that repeatedly breaks the law. Recently, Acting Comptroller Sue outlined the first draft of such an escalation plan where bank regulators would impose tougher penalties, including breaking up a bank that repeatedly breaks the law and is too big to manage. Does this seem like a good idea? And what should all of our financial regulators outline? Should they all outline a plan using the enforcement tools they already have at their disposal?
Thank you again. Yes, to myself, and I'm sure my colleagues at Americans with Financial Reform would agree, even going back to the chart that Ranking Member Foster used earlier showing bank failures, one of the periods he highlighted was one of the periods after when we passed the Glass-Steagall Act, which, goes to taming how large banks can grow, and we can see from then that failures were markedly less than they are now. So plans that make sure to keep banks, following, being not too big to manage, we definitely agree with that. Thank you.
Thank you. Let me continue. I'm interested in learning how we can strengthen data privacy standards to better protect consumers. I know this is a priority for Chairman McHenry, but I've heard some concerns with the approach taken in the discussion draft we are considering today. For example, according to California's State Privacy Agency, the discussion draft we're considering would preempt state laws, including those in my home state. The draft would prevent states from adopting new protections in response to changes in technology, something the current law allows. And so, Mr. Chairman, I would ask unanimous consent to enter the full statement from the California Privacy Protection Agency for the record.
Without objection.
Thank you, Mr. Chairman. Ms. Marcelin, what concerns do you have with this discussion draft? For example, we know the Republicans have made it their mission to undermine if we do not get rid of the CFPB, but will consumers be better off?
Thank you.
The gentlewoman's time has expired. If you could submit your response or real quickly.
Yes, the CFPB's role in protecting consumer financial data should be reaffirmed in any proposed legislation. Thank you.
Okay, thank you.
Thank you.
The gentleman from Missouri,
back.
Mr. Luchtenmeyer, is now recognized.
Thank you, Mr. Chairman. Over the last few years, I worked on a beneficial ownership bill in the 116th Congress alongside Chairwoman Maloney. The goal of that legislation was to stop law enforcement from deputizing financial institutions to collect personal data from consumers. To do this, small businesses would submit simple, straightforward information to FinCEN's database regarding who the owner is of a particular business. This information would help law enforcement crack down on shell corporations participating in illicit finance. However, I'm concerned that FinCEN is not appropriately implementing this legislation into law. Mr. Reuter, your testimony discusses the beneficial ownership rule currently being promulgated by FinCEN, which would result in banks being unable to use FinCEN database fulfill their customer due diligence requirements. Would you like to elaborate just a little bit on the aspects of that rule that are particularly troubling to you?
Yes, I would. Thank you, Congressman. The original intent to have a database that not only FinCEN could use, but the banking industry used to identify customers and beneficial owners was a great idea. Unfortunately, it looks like the revised versions and many of the current discussions show that they're going to limit access to that or make it very difficult. And in addition, they want us to still collect all that information, so a complete duplicative process. And then there's some concerns that reconciliation of the two will create additional compliance burdens. So we have 30 people in our AML BSA operation as a bank right now, and I think the
That makes you a
spirit
lot
of
of money, doesn't it?
BSA
Those
is,
people
yes.
Shuffle papers around, it makes you lots of money, doesn't it?
And BSA is super important to catch illicit activities and anti-money laundering, but we need to do it in the most efficient way.
That's not the way that this system was envisioned, though, was it? You were
No.
supposed to, when they promulgated this rule initially, you were going to be able, the banks were going to be able to access this so they could complete their forms, so they could complete the information they need to send in. Is that not correct?
That is correct.
So this is a complete reversal of what the intent originally of that bill was. Thank you. Also, Mr. Roeder, I noticed your testimony mentions my legislation, the Customer Information Notification Requirement Act. Thank you for that, which would update GLBA to provide one robust national data security and breach notification standard. Would you like to, I'd like to thank you for your support of legislation. Would you like to elaborate on the problem that it solves with regards to this patchwork of state laws that you have to comply with?
Yeah, so I mentioned earlier, we're in the business of trust, and we've been trusted with information for many years. GLBA has been around for 20 years, and I think it's been a great model for the banking industry. I would really strongly encourage that the prudential regulators be the ones that continue to oversee compliance, but trying to comply with 50 different state laws would be cost prohibitive and extremely challenging. Even though I said we're headquartered in Colorado, we have customers in all 50 states. So when I think about the prospects of 50 different state laws, if we had an unfortunate data breach incident, that would be almost impossible to administer. Right now, the 5 states that have passed state-level laws, only California is the one that is not giving preemption for GLBA. And so I think it's really important as we operate. Our customers move. The great thing about technology, as Penny said earlier, people can bank anywhere, and they do that. And we've done a great job as a bank, so they stay with us even when they're in another state.
A really simple fix to what could be a really major headache for you, is it not?
Correct.
Thank you. One key aspect of this hearing is the role of technology in providing access to credit for unbanked and underbanked individuals, an issue that receives bipartisan support here in Congress. However, the actions by this administration and the Federal Reserve seem to directly contradict this idea of increasing access to low and moderate income consumers. Currently, the Federal Reserve Vice Chair, Chairman Barr, is re-examining the U.S. capital regime and is looking to significantly increase bank capital in the United States. Mr. Roeder, how would the ability of your bank be able to provide credit to low-income consumers be impacted by your capital requirements if they were significantly increased?
You know, I think the proposal makes a lot of sense, because to start with enough capital for the growth you'll see 3 to 4 years down the road, that's a big check to ask the original investors to write. And it was mentioned earlier, makes it almost impossible to start a new bank. So a phased-in capital approach is very logical. And I think it's also prudent from a risk standpoint as the bank grows.
Okay, but the question is basically you're increasing your capital to be able to address low and moderate income folks. Is that a necessary situation for you to address low and moderate income folks?
Absolutely. It is important we bank the entire community. So new banks help in that endeavor. And as I said earlier, our 300 officers on the ground make a big difference.
I yield back.
Thank you. The ranking member of the subcommittee, the gentleman from Illinois, Dr. Foster, is now recognized for 5 minutes.
Thank you, Mr. Chairman. We've talked repeatedly about sort of the two main factors that are driving both consolidation and discouraging de novo entities. You know, those are regulatory compliance costs, which are part of it, but also the digital economies of scale, which I think are really the most fundamental one. In Mr. Knight's testimony, he referenced the BB&T and SunTrust merger, and the article that you linked to in your testimony was exactly on point. on that, you know, this was a merger driven by the need, or at least the perceived need, to compete in the high-tech, you know, to provide state-of-the-art apps and user interfaces for people, which is not cheap and is not realistically going to be done by every little individual community bank. And so I wonder if the witnesses could just weigh in on how we answer, particularly the second one of those. How do we answer the digital economies of scale? That I guess, Mr. Reuter, you must be right on the edge of being able to do that all in-house. I don't know if you contract it out, but how do you handle that? And how do you avoid this continuing to drive merging and drive the small players out of business?
It is an extreme challenge for the industry. Technology is very important. Technology is also getting cheaper over time, though, I would tell you that, and you can find fintech partners to help lower the lift, but it goes without saying that the cost of investing in technology is a big challenge for community banks.
Any other comments on this? When I look around at areas of potential bipartisan agreement, I guess I've mentioned the concept of multi-level preemption. So instead of having 50 different standards, you might have a small handful, each one representing 20% of the U.S. population or something like that. It seems like that's somewhere that we could all end up happy. So those who agreed with the California approach to something could say, okay, those states will join California in one consortium. Others who maybe want to join Louisiana or something like that may come to a different set of standards. And I think that's something we should investigate on a bipartisan basis, as a way out of the conundrum there. Another area is that of secure digital ID. I was very struck by, during the COVID crisis, of seeing an estimate of roughly $400 as the cost of onboarding a new customer. And I see some nodding that it's somewhere in that range. And so the technology that exists in many countries and ought to exist here is simply the ability of a consumer to, get out their cell phone, show it your thumbprint or your face, so you're registered with your cell phone, and then use that to present your Real ID compliant digital driver's license or something, and that way authenticate yourself as a single legally traceable human. And that, along with an appropriate, whitelist or blacklist of bad players, would allow, an emerging fintech, for example, to very quickly establish a way of onboarding customers at much lower cost. Avoid the identity fraud, which is a scourge and a source of huge cost for consumers, for businesses, and for government. We got actually very close into getting a big step forward, actually in the omnibus bill, with bipartisan and bicameral elements and support. But that's something where I think we have to get that across the finish line, because it is unnecessary and falls most severely on low-income people who actually don't have an established credit history and everything else. But if you have a secure way of proving you are who you say you are online, is something that will have huge benefits across the board, and particularly to the smallest players and to startups. So that's something that we had a very nice colloquy about that with Representative Hill on our organizing session. And so I was wondering if any of you have comments on the way to go. I guess if any of you operate or are familiar with what happens internationally, where that is something that's being provided. Any comments on the way? Yeah.
That the new, that's something where an area of a new bank that, or a de novo bank that would have expertise on certain technologies such as blockchain might very, very well come in handy, or can help fill the void. It's not just technology is costly, and it may seem on the surface that larger banks may be more the ones to handle it, but a smaller bank or a new bank with expertise in a certain type of technology may add something crucial to data protection, and that's in some contexts.
Thank you. Yield back.
Thank you. The gentleman from Texas, the chairman of the House Small Business Committee, Mr. Williams, is now recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you for all of you being here today. As we've heard today in this hearing, innovation will help to drive and strengthen our economic growth. We need to empower the private sector to develop innovative solutions to give more individuals access to financial services to bring more people into our banking system. One way the government can help incentivize innovation and help our nation's entrepreneurs is through the tax code. When an entrepreneur sees the opportunity to keep more of their profits, a good word, not a bad word, profits, from a successful business venture, they are more likely to take risk and invest in their capital. Unfortunately, the Biden administration wants to increase taxes on businesses and decrease the incentive to bring these new innovations to the marketplace. So without proper profit incentives, it will be difficult to convince entrepreneurs and startups and investors to take risk and deploy their own capital. So, Mr. Reuter, as a banker for over 34 years, can you discuss the effects that increasing taxes will have on innovation within the banking industry, and how would this hurt investors who are taking the financial risk to bring new products to the market?
You know, it goes without saying, the more money that's left in the private sector, the more innovation that happens. And we've seen this time and time again. Today, we like to talk about big companies like Apple and Microsoft, but let's remember they started as small companies with entrepreneurs. So it absolutely would be beneficial to keep taxes as low as possible.
Well, if you have more money, you loan more money. Pretty
Correct.
simple. Smaller banks often rely on partnering with third-party service providers to offer similar services to their larger counterparts. Current law authorizes federal regulators to examine these third-party service providers to assess potential risks they pose to individual banks and the banking system. Now, the problem is that the results of these exams are not shared between the federal and state level, leading to duplicate exams from both regulators. That's kind of like what government does. And I have a bill to fix this common sense issue by sharing these regulatory exams across the board, and this will promote more of an efficient supervision of third-party services that are heavily relied on to provide a wide variety of banking services, saving smaller entities time and resources. So, Mr. Knight, could you talk about how over-regulating smaller entities affects their ability to operate?
Yes, thank you for that question. As is common sense, regulation requires there's a regulatory barrier that has to be paid for. Now, there may be times and situations where that's entirely justified. But if we don't regulate based upon the risk generated by that entity and instead regulate on the basis of speculative, hypothetical, or sort of an inapt model, we risk imposing greater costs. You referenced taxes earlier. You can view regulatory cost in some ways as sort of the flip side of taxation. Both are necessary to some degree, but excessive amounts of either are going to have negative consequences that are undesirable. And in both cases, we should be striving to figure out how to achieve whatever legitimate benefit we're trying to achieve in the most efficient and least invasive way possible.
Well, and it's a way of inflation too when you do this. So
You can certainly make that argument. You can make an argument that regulation allows, a sort of excessive or complex regulation allows for, the provision of favors. There are any number of challenges or problems to excess regulation.
Since day one of taking office, the Biden administration has brought back the heavy hand of government regulations. Now, this is hurting banks and third-party service providers that have been crucial in expanding access to financial services for business and entrepreneurs across the country. Democrats' regulation policies will require banks to hire more compliance officers. Well, we need banks to be hiring more loan officers so they can get money to Main Street businesses quickly, and rather than having to navigate the complex web of regulations so quickly. Mr. Burlaw, can you discuss how this regulatory uncertainty coming out of the Biden administration is harming community banks?
Yes, well, a community bank, even one compliance officer, one extra employee for compliance, as the research from the Mercatus Center and others have shown, it creates a trade-off as far as banks making loans. So, there's definitely regulation, as we say at competitive enterprise, is very much a hidden tax. So when it's not rational or related to the problem, that's especially a cost.
Yeah. Well, I'm in the car business, and everybody in my business is on commission. And I've even had to hire a compliance officer. And you guys have heard me say, how the heck do you pay a compliance officer on commission? If you think of that, let me know, would you? And I just closing out, I'd like to say, Ms. Lee went to Baylor, I went to TCU. Go Frogs. I yield back.
Sick 'em Bears.
All right, great to have that rivalry on full display. The gentlewoman from New York, Ms. Velasquez, is now recognized for 5 minutes.
Thank you, Mr. Chairman and Ranking Member. Ms. Marceline, I agreed with Ranking Member Waters that my friends on the other side of the aisle are intent to undermine the CFPB and the rules it enforces. They often just justify their actions by arguing that the CFPB and regulations from the Dodd-Frank Act are burdening community banks and credit unions with onerous regulation. But isn't it true that the CFPB must consider how its rule impact small banks before promulgating the rules?
Thank you, Congresswoman Velazquez. Yes, that's exactly right. The CFPB, by matter of law and practice, consults with small banks, credit unions, and rural banks to better understand how their regulations will affect these institutions. I also want to note that the CFPB authority in regards to banks, they have authority over banks with over $10 billion in assets, first of all. And lastly, regardless of the size of the institution, consumers should always be protected when they're offered financial products. It is the one agency that's actually tasked with the mission of protecting consumers when they're taking out financial products. There are lots of other agencies. If you're getting a toaster or a car or whatever else, there are agencies looking out for your safety there. And up until 2011, when the CFPB opens its doors, that's when we actually had someone looking out for consumer financial products. So, yes.
Thank you. Ms. Marceline, the purpose of this morning's hearing is to discuss ways we can revitalize banking in the 21st century. What is notably absent from the majority's memo, however, is any mention of the CFPB. Can you speak to the importance of the CFPB and maintaining its independence in order to protect consumers and revitalize banking in the 21st century?
Thank you again. So again, just pointing back to my initial statement of why the CFPB was created in the first place. And, I just want to add, when, bipartisan polling was commissioned and showed that when consumers actually heard what the CFPB does and what they're mandated to do, that 79% of voters across the political spectrum supported it. I also want to point to the Dodd-Frank Senate report that was created, when Dodd-Frank bill was being legislated. It pointed to the FHFA's predecessor, the Office of Federal Housing Enterprise Oversight, which oversaw Fannie and Freddie at the time. And it stated very clearly that one of the reasons that office wasn't as effective was because they were subjected to the annual appropriations process, which lessens their independence and made it unlike other federal financial regulators at the time. Having a steady fund of streaming, like most federal financial regulators, also helps to secure and lead to the continuation of rules that help to create market certainty, whether in our financial system or in the economy at large. So it is very hard to have an independent agency if you're going to subject it to the annual appropriations process. And this was done intentionally by Congress, as pointed to by the report.
Thank you. This Congress, Ms. Marceline, I am once again planning to reintroduce the Promoting Fair Lending to Small Businesses Act that ensures the CFPB has both oversight and examination authority over non-bank lenders pursuant to Section 1071. Can you speak to the importance of ensuring that the CFPB has both supervisory and fair lending enforcement authority over non-bank lenders?
Yes, absolutely. So, want to point to the fact, I believe it was in 2020, that non-lenders issued about 2/3 of all mortgages issued. So we're seeing, and I go into detail to this in my written testimony, we're seeing the rise of the non-bank sector surpassing, to some degree, lending by banking sector. So having adequate supervision over that sector is of utmost importance. Lastly, we need, something to track, and that's what 1071 gets to. The same way how we have HMDA data, we need that for small businesses, for small borrowers as well.
Thank you. Mr. Reuter?
Yes, Congresswoman, I am in support of like activities being regulated in a like manner.
Thank
So
you.
would be
I
in
yield
support.
back.
The gentlelady's time has expired. Before I move to the next witness, the ranking member would like to be recognized for a request.
Just like to ask unanimous consent to insert the two charts that my staff.
Without
distributed for
objection.
the record.
Without objection. The gentleman from Georgia, the vice chairman of the subcommittee, Mr. Loudermilk, is now recognized for 5 minutes.
Well, thank you, Chairman Barr. Congratulations on your post as leading this committee, and thank you for holding this. This is incredibly important because we need to think back of when Gramm-Leach-Bliley was enacted. I've got 30 years in the IT industry. I remember that year of 1999 distinctly because we were preparing for Y2K. All right? The Nintendo Game Boy had just been released. Dial-up modems were finally on their way out, and we were getting these whopping speeds of 2 to 6 to 10 megabits on cable modem and DSL. These devices were non-existent at the time. We were just being introduced to the BlackBerry in its introduction. Needless to say, we've come a long way. And one other interesting statistic, a dozen eggs were 89 cents, if that doesn't age us where we are today. So, and Google was only a year old as a search engine. We've come a long way since then, and Fintech was non-existent, and multi-billion-dollar industry of big data was non-existent. But the law that is regulating us was built around the technology of that day. So, Ms. Lee, as you mentioned in your written testimony, 8 in 10 Americans now use Fintech, which is technology that was not even dreamed of when GLBA was enacted, correct? And that's been many years ago. Can you give us a bigger picture of how the financial service industry has changed as well in that time and the role Fintech has played in those changes?
Well, thank you for that question, and you're right. It has been, we have definitely moved from the paper age, or the dark ages, as you might want to allude to, into the digital age. And we need to have our rules and regulations reflect where the future of various different products and services are moving. As I alluded to in my opening statement, you're seeing a proliferation of technology, and specifically financial technology, enter into people's lives, how they interact in just simple things as sharing money with a friend across the dinner table, to be able to pay for meals, to be able to be the infrastructure. Financial technology allowed for e-commerce to occur, for small businesses, especially during the pandemic, to transition for a restaurant from just a brick and mortar into a delivery service, to be able to keep their restaurants open during that time. It was the underpinning of financial technology that allowed for that to occur. As Brian alluded to, also during the pandemic, financial technology was facilitating a lot of the loans going out to the smallest employers and bank, or smallest businesses that were there. And so you're seeing it kind of come into various different means, various different ways. It means something different for every person depending on how they interact. What you see is today, especially in the millennials generation, it's no longer going to just one financial institution to do a full bundle. You're now seeing a scattering. They might have one app to do budgeting, another app to do investing, another app to pay for certain things. So you're seeing it being used in very different ways.
And in the various ways we're using it, we have a massive amount of data that is being collected and retained on each one of these users. And data collection and data retention is an area I'm greatly concerned with. Do you believe that it is imperative that we update laws like GLBA at this point because of that?
Absolutely. We do have a tremendous amount. And I would say, though, there is a distinction between data and financial data. It is protected under GLBA in a much different way, but we do need to update it to include things such as giving the consumer the right to delete for giving the transparency in what we need to do, so they have a clear understanding where their data is going, but also give them the ability to share it in a manner in which they would prefer to whatever services, digital service or other, that best fits their own financial needs. So there's a lot of different elements, and as we alluded to in our own privacy principles, paramount, consumers should have the choice. Second of all information and how it's shared should be transparent, and providing them the ability to delete.
All right. I see my time is quickly eroding, but I do have to say on data collection and retention, Mr. Reuter, I think it's time for us to update the Bank Secrecy Act to reduce the amount of data we're forcing on small financial institutions to report to the federal government, who retains it and never looks at it. With that, Mr. Chair, I yield back.
Thank you. The gentlewoman from Ohio, Ms. Beatty, is now recognized for 5 minutes.
Thank you, Mr. Chair and Ranking Member. My first question goes to you, Ms. Marcellin. As we know and we've heard today, CDFIs and MDIs play an essential role in our financial services, providing low to middle income communities and underserved businesses with access to financial services. I'm deeply concerned about the fact that many of these institutions are falling behind large banks with resources to adjust to change in technology and in other areas. Several of our witnesses today made reference to technology and some of the things that happened during the PPP loans, where some of the fintechs were at higher rates, interest rates and rates giving to smaller banks. So this is kind of personal to me, because I got good news this morning that in my district, MDI has been approved and will open in a few weeks, a Delphi bank. So I am very much invested that it's in the heart of my district and that it is a Black-owned MDI. As you know, only about 19 or 20 Black-owned MDIs exist now. And this will provide a great opportunity to serve under and unbanked communities. But my question is, what can Congress do to support MDIs like Adelphi Bank and other CDFIs in communities without undermining consumer protections and prudential standard service, such as capital requirements? What can we do to make them more successful?
Thank you, Congresswoman Beatty. First, I would like to say, first and foremost, increasing funding for the CDFI fund. There has been a recent increase in funding there, but it still doesn't match what it could be, and that would be the first thing I would recommend. Secondly, the CRA is being rewritten as we speak. Maintain and expand CRA consideration for community development activities in LMI communities, and I think this will greatly help to benefit CDFIs. And lastly, I would say, continue to adopt reforms that can drive investments in less populated region and communities of color, including rural and Native communities as well.
Okay, thank you. Sort of in that same vein, we know that FDI survey found that in 2021, 5.9 million households lacked a bank account. Although this was still the lowest rate of unbanked since 2009, we're still struggling to reach millions of individuals out there. Do you have any suggestions for why this problem is so difficult to solve, and what can we do? We've heard both sides of the aisle talk about unbanked and underbanked. We've heard about capital, whether we should increase the capital, what could that do to MDIs or small banks?
Yes, thanks again. So first, if we point to the FDIC's recent data, yes, the underbanked population has gone down, but if you look exactly like you said, across race, it is still disproportionately high. First and foremost, one of the main reasons cited is lack of trust among banks. Secondly, not being able to afford the cost of banks, and this goes back to my testimony as well in discussing how mergers has led to the increased cost of whether it be minimum balances for accounts, ATM fees, and such. Folks really just can't afford the cost of maintaining a bank account. And also, I want to point even to that celebratory fact of unbanked population decreasing. And one of the main reasons for that, and the FDIC cited, is because of the stimulus checks that people received because of the CARES Act. So it kind of underlines the main point. When people have money or income, they open bank accounts. And I think anything that we can do to support that and increase wages and such, including what else I said, will help to fix this problem.
Thank you. I'm not going to have time, but to Mr. Knight, you said on page 2 of your testimony, you also referenced what happened with small businesses during the PPP and that they were giving loans at higher interest rates. So maybe you can address that same question in writing. Thank you, and I yield back.
Thank you. The gentlewoman's time has expired. The gentleman from Tennessee, Mr. Rose, is now recognized for 5 minutes.
Thank you, Chairman Barr, and that has a nice sound to it, and Ranking Member Foster for holding this hearing today. I'd like to begin by yielding 30 seconds to my colleague, Mr. Lukemeyer from Missouri.
Thank you, Mr. Rose. Mr. Roy, I think we missed connections on our question a minute ago. The question was basically, we got too many bars around here is our problem. We got a Fed regulator named Barr, we have a chairman named Barr. Let's cut all that out. The Federal Reserve regulator is re-examining the U.S. bank capital regime and is looking to significantly increase bank capital in the United States. How would this affect your bank and its ability to service low and moderate income folks?
Increased capital reduces our ability to lend, period, whether it be low to moderate income neighborhoods or any part of our community.
Thank you very much. I yield back my time, Mr. Rose.
Thank you, Mr. Lukemeyer. I am concerned, Mr. Reuter, about the current Bank Secrecy Act process where the federal government deputizes financial institutions. I spent 10 years on the board of a national bank where I was tasked with looking at suspicious activity reports, as all bank board members are. And the lack of feedback that banks and other financial institutions receive on whether a specific filing was helpful in assisting law enforcement is extremely troubling. I've said it's like shooting at a target in the dark with a blindfold on. Mr. Reuter, how much money do you think your institution spends every year on BSA filings and related compliance?
I don't have the exact dollars, but I can tell you I have a 30-person team. That is all they do. And we do most of our IT in-house, and there's not a year that goes by we don't have 2 or 3 IT projects dedicated to AML BSA. And we would love feedback as to whether we're making a difference or not.
I imagine so, and that was certainly my experience as a board member. Mr. Reuter, is that typical of a bank of your size, do you believe?
It is typical of a bank of our size, and I think it's even more extreme in states that have higher rates of potential money laundering risk that are states that have more international activity.
And I take it from the answer you've already given that you're not satisfied with the feedback that you get from FinCEN or from law enforcement about whether particular SAR filings were helpful to them.
No, I'm trying to motivate a team, and I always say they're doing great work on the front line, so to speak, because they're playing a really key role, but some substantial feedback would even be more meaningful to them.
Mr. Reuter, last night President Biden mentioned junk fees in his State of the Union address. As you know, a junk fee is a made-up term by an overly aggressive regulator running a rampantly unaccountable agency. That's my assessment. I have previously asked Director Chopra in this room to define junk fees for us, and he filibustered, as we have all become accustomed to in this room. So, Mr. Reuter, has the CFPB ever given you a succinct definition of a junk fee?
No. In fact, it's quite confusing when the fees we are charging are clearly disclosed within compliance of the existing laws, that suddenly one person can interpret that a different way.
You testified that Congress should urge the CFPB to streamline its small business lending data collection and reporting rule under Section 1071 of the Dodd-Frank Act. Unfortunately, the CFPB does not streamline anything and instead harasses our banks and creditors. Moreover, Director Chopra has shown a lack of concern for the costs associated with his rulemaking. His staff estimates that the annual ongoing costs of this junk rulemaking will be between $372 million and $392 million. Mr. Reuter, do you believe that the increased cost associated with the 1071 rule will reduce competition in small business lending?
Absolutely. When you significantly increase the regulatory burden over a line of business, some banks simply choose, because it's not a big part of their strategy, to get out of it. We've seen that in the mortgage business. I worry we will see that effect with some small business lending if we're not careful.
Thank you. And again, Mr. Reuter, in October, the FDIC voted to raise deposit insurance assessment rates for banks by 2 basis points. The changes amount to a 54% increase in the current average assessment rate. Given that deposits are dropping and expected to drop further, what impact will the new assessment rate have on your bank?
Bottom line is it's increased our cost of doing business. There's less net income, which is less retained earnings, which is less capital to loan out into the community. Our deposits grew 42% during the pandemic. I think as an industry, we did an outstanding job of helping customers with their EIPs and the PPP. We were the #1 bank in the state of Colorado for PPP lending. And so as a result of that deposit growth, now it's going out, and we're still paying those higher deposit premiums.
Thank you. Mr. Chairman, I yield back.
Thank you. The gentleman from Texas, Mr. Green, is now recognized for 5 minutes.
Thank you, Mr. Chairman. I thank the ranking member as well. Mr. Chairman, members and friends, Northwestern University published an article styled "Racial Discrimination in Mortgage Market Persists Over Last 4 Decades." But they go on to indicate in a subtitle, "Discrimination in Housing Market Sees Decrease During Same Period of Time." This was published on January 23rd of 2020. Let me read an excerpt from the article. In the mortgage market, the researchers found that racial gaps in loan denial have declined only slightly, and racial gaps in mortgage cost have not declined at all, suggesting persistent racial discrimination. Black and Hispanic borrowers are more likely to be rejected when they apply for a loan and more likely to receive a high-cost mortgage. The question that I have for you, dear friends, is one that has haunted us and continues to haunt us to this very day. And it is this: what are we going to do about the invidious discrimination in mortgage lending that allows a person who is more qualified, person of color, more qualified than a white person, to receive a loan at a higher interest rate and receive less in the amount of the loan? Ms. Marcellin, what can we do to correct this injustice?
Thank you, Congressman Green. First of all, I know the CFPB has been kind of talk of the town, but going back to them, they just shoring up their authority in this space. Going back to mortgage lenders, a lot of them being non-banks. The CFPB just released their non-bank supervisory guidance, making sure that that is strong as possible. That's one thing Congress can do. They were recently, filed a lawsuit against them upgrading their UDAP practices to prevent this sort of thing, discrimination by disparate impact, making sure that, we are out there really educating consumers on what the CFPB can do, and making sure that then when battles come their way, when folks are looking to undermine the agency, that we are shoring up their authority in these various spaces.
Mr. Reuter, what can we do to correct this injustice?
Congressman, we have a very robust fair lending program at our bank. We're also regulated.
If I may just intercede, please, I don't mean to be rude, crude, and unrefined, but could you not address your bank and please address the injustice?
Yes.
The injustice, thank you.
The entire industry is heavily regulated and tested for fair lending. The #1 originator of mortgages in the United States the last year was Intuit with their Rocket Mortgage. They do not have the same robust supervision and regulation as the banking industry. So I think like activities with like regulation would be a good place to start as well.
Let me make a couple of suggestions. having lived a good deal of my life as a person of color and having experienced exactly what I've called to your attention, as a matter of fact, I and 3 other lawyers received a loan, paid it back early, never missed a payment, went back to get another loan, had a different loan officer, and that loan officer denied us a loan and told us we shouldn't have received the first loan. So this is something that I have personal knowledge of. It happens. And I'm grateful that you haven't denied this, because many members of Congress would deny it. So I'd like to place in the record, if I may, Mr. Chairman, my Fair Lending for All Act. It establishes criminal penalties for violations of prohibited credit discrimination, and establishes an Office of Fair Lending within the Consumer Financial Protection Bureau. Here's something that was inspired by Ms. Beatty.
Without objection.
Thank you. Inspired by Ms. Beatty, and I'm so grateful to her. She's been a wonderful chairperson when she had the mantle. The Securities and Exchange Atonement Act, which requires insurers of securities to carry out a racial equity audit every 2 years regarding their diversity, equity, and inclusion, as well as direct or indirect ties to slavery. The next would be my Promoting Diversity and Inclusion bill, Diversity and Inclusion in Banking Act, requiring regulators to include diversity in their assessment of depository institutions on the Uniform Financial Rating System or comparable rating system. Mr. Chairman, if I may have a unanimous consent on one last bill, it is a unanimous consent request.
Yes, the gentleman's time has expired, but real quickly.
Thank you, sir. The Housing Fairness Act, which mandates that HUD conduct a nationwide testing program to direct and document housing discrimination.
Yes, without objection.
Thank you for your kindness.
Gentleman's time has expired. The gentleman from South Carolina, Mr. Norman, is now recognized for 5 minutes.
Thank you, Mr. Chairman. My good friend Al Green I like, but I hope each one of you can fire back and kick back on some of these allegations to bring up slavery, to bring up not getting loans because of your color. I sat on the bank board for 20 years. Credit scores apply to everybody. You're in a competitive business. You have stockholders to answer to. This constant drumbeat is really getting tiresome to hear them day in, day out talk about discrimination. We'll fight, you know, the regulations, his bills, because it makes no sense.
The gentleman called my name.
Said,
the gentleman yield
let me
10 seconds.
I will not. It's my time.
Yes, sir.
Let me, how do I handle? We had a situation where a wire transfer was a fraud that a bank had. When I asked why we're not, what mechanism do you have among banks? They didn't want it out because of obvious reasons, the devaluation of stock and that type thing. Am I missing something? Is there some other line of communication that banks have? The insurance kicked in, but guess who's paying the insurance? The banks. So in any of, doesn't matter, any of you could address that.
Congressman Norman, I would say I would agree with Congressman Green that discrimination where it does exist must be vigorously fought. I don't know if I would agree with all of his proposals, but I think one place where
I'm asking about the fraud. I'm asking about how we, the instance I mentioned was about the wire transfer, and that's a breach, and the insurance paid off. But what I'm saying is, and I get the banks could not let it out because of the publicity and stock devaluation, but is there other things that we can be doing to help get the word out with that?
I think I can't speak, I don't know about that specific incident. I think what everyone in Congress could be doing is making it easier for all types of de novo banks, including minority-owned de novo institutions, to open so that there would be more, so that consumers would have more choices, And as a result, people would be treated more fairly, and have and underserved areas would have more choices and be able to have an easier road to prosperity.
Anybody else have any? Okay, Mr. Riders.
Congressman, we do see this where someone will intercept an email and impersonate that there's someone in their office and ask them to send a wire. So we do robust education. We have technology in place to look for unusual wire activity. We also hold forums for our customers, a lot of our business customers, to educate them on the risks. And given the fact that we have a strong cybersecurity team, we spend time with those customers' teams to help educate. So again, I would call that the great work of a community bank on the ground, bringing people in and educating.
Let me just cover the regulations that I think by this administration are strangling banks. The FDIC cited banks for non-sufficient funds, NFS fee. The CFPB, you're talking about a rogue organization that's gone off on its own interpretations, unfair, deceptive, and abusive acts. What's the impact of this having on operating a bank that's got to operate for shareholders, both black, white, red, it doesn't matter? How is this affecting the banks?
It absolutely affects the capital and the dollars we have available to make advances and solve for some of the customer issues that we face every day. So clearly has an impact.
And does it have you, and I don't have much time, doesn't it force banks to pull services that ordinarily they wouldn't have to do if they didn't have to deal with this?
Correct. There's some banks that simply get out of lines of business because of the increased cost.
Well, I appreciate what each one of you do, taking your time today, and
would the gentleman yield for a point of clarification on his statement?
Mr. Green. Mr. Green, I think, asked for.
Thank you for your kindness. I will extend a similar courtesy to you at some point in the future, I'm sure. My dear brother, for many people, invidious discrimination is a term. For others, it is a way of life. Northwestern University accorded us this intelligence. It's not something I compiled on my own. And there's much more to be said about the empirical evidence.
The gentleman's time has expired. The gentleman from Illinois, Mr. Caston, is now recognized for 5 minutes.
Thank you, Mr. Chairman. Nice to see you all here. So last week, my colleagues across the aisle voted to denounce socialism in all its forms on the House floor, and I would like to use my 5 minutes to join them in a full-throated denunciation. We are seeing capital markets move massive amounts of capital right now to protect themselves from climate risk. We're seeing huge surges away from properties at risk, coastal flooding, wildfires. We're also seeing a flight to quality. It was just looking just now, right now, ExxonMobil and Chevron are both trading at a 6 times multiple on forward earnings. NextEra, clean energy developers, trading at a 15 times. First Solar is trading at a 60 times. We are seeing this massive flight of capital. We are also seeing the single biggest class of investments are these ESG funds. PricewaterhouseCoopers reported there were $18.4 trillion in global assets under management at the end of 2021, projected to grow to over $30 trillion by 2026. This is capitalism red in tooth and claw, as they say. And yet we're seeing a number of states who find capitalism uncomfortable when it's not benefiting them. And so we're seeing states that are now blocking their pension funds from investing in things that are optimizing risk and return if it has the name ESG in it. Mr. Chair, I'd ask unanimous consent to enter 2 documents into the record on a couple of points I want to cite here. These documents show that in Texas, this law is costing taxpayers $532 million. As you'd expect, if you run away from capital markets, bad things happen. Kentucky, Florida, Louisiana, I'm forgetting some here, West Virginia, more than $700 million a year. In Indiana, the estimate is that this is going to cut pension returns by 125 bips, from 6.25% to 5%. And if we are going to denounce socialism in all its forms, we need to denounce it even when it comes from our friends. And my good friend, Mr. Barr, is now leading an effort to overturn a Department of Labor rulemaking that would allow fiduciaries to consider climate risk and ESG factors when selecting investments. And I'm here to denounce socialism in all its forms. Ms. Marcellin, do you believe that retirement savings are at risk if that Department of Labor rulemaking is overturned?
Thank you, Congressman Caston. Yes, absolutely. Climate change is a hidden risk for retirement savings. As you said, the anti-ESG movement is not only trying to get pension fund fiduciaries from ignoring the risk of climate change, but frankly also ignoring the opportunities. There are those in the Senate right now that's trying to repeal the Department of Labor ESG rule, and that will put retirement savings, especially of those of working class, at risk, and like I said, foregoes potential investment opportunities as well.
So help me out with what that risk means. Who's going to bear the cost, whether it's these Indiana pension funds that are seeing lower returns? Who ultimately is bearing the risk of this redoubled commitment to socialism that's going on in these states?
Yeah, ultimately it's the workers, and many of whom are hourly wage workers who was hoping at the end of a long career, maybe they retired at 60 to get a pension, a steady pension to fund themselves into their seniority and live a comfortable life. And at the end of the day, those are the type of people that are suffering.
Well, thank you for your time, and I just make the observation, and many of my colleagues have heard me say this before, the absolute loneliest position in Washington is to advocate for competitive markets. No one ever comes to our offices and says, I wish my industry was more competitive. And when you are on the losing end of capitalism, you can either adapt your business, you can learn to pivot, or you can call it woke. And I hope that all my colleagues around here hold up the vote they took last week and denounce socialism in all its forms as we try to look out for the workers and the American people and the investors in our economy. Yield back.
The gentleman yields back. The gentlewoman from California, Ms. Kim, is now recognized.
Thank you, Chairman Barr. I would like to yield 1 minute to you so you can make your remarks.
Well, thank you for yielding. I'll be brief, but I couldn't resist the temptation to rebut my good friend from Illinois and his comments since he invoked my bill and my legislation. Look, I have no problem with anyone who wants to steer their own investment, deploy their own capital into less diversified, lower performing, higher fee funds, if that's what they want. If they want lower returns, capitalism allows that. I'm not for socialism. I'm not for forcing people to allocate their capital in ways that they don't want to. But the point is that ESG funds over the last 5 years have underperformed the broader market 250 basis points per year. And it's because they're less diversified. They exclude energy stocks, which have overperformed the market. So if you want capitalism and free flow of capital, you do not steer people into lower performing, higher fee funds like ESG funds. And let me just make the final point before yielding back to my friend from California. The flight to quality that my friend from Illinois talks about is not a function of improved corporate performance. It is a function of an asset bubble. It's a function of a growing pool of capital chasing socially conscious investment opportunities that have higher fees and lower returns. The best reason for investing in ESG-oriented companies is that everyone else is doing it. That is the definition of an asset bubble. And with that, I yield to my friend from California.
Thank you, Chairman. I want to thank you and Ranking Member Foster for holding this very, very timely, important hearing. I want to address my comments about the bank charters declining by approximately 20% in the last 10 years. And, if you look at 2022 statistics, there were about 5,900 banks, commercial banks in the United States compared to today when we look at just under 4,800. So the banks have seen the biggest decline. And to that end, I want to thank our Chairman Barr, his efforts through the legislation that he introduced, H.R. 758, to incentivize de novo formation. And I want to direct my first question to Mr. Reuter. In your written statement, you noted that there has been about, 46.3% decline in de novo formation since 2005. So can you talk about, in your view, what has led to that decline in our financial system?
There's a few major themes. One is the compliance regulatory cost, the cost for technology, and then also the capital that you have to put forward to start the bank. When you put all three of those together, it's very difficult to start a brand-new de novo charter.
Any quickly in terms of a regulation that kind of prevents them from doing so?
There are, preparing for this hearing today, I don't think I've ever seen a wider waterfront of new legislation for our industry. It was one of the most challenging hearings I've ever prepared for. So that just tells you how much bigger the burden is today.
We got a lot of work cut out in that field. Mr. Knight, I want to ask you a question. In your testimony, you laid out several examples like the OCC's broad definition of reputational risk and non-binding guidance from regulators as clear disincentives for new financial institutions and innovation to enter the market. So in your testimony, you also call on Congress to engage in more rigorous oversight to curb those onerous regulations. So can you elaborate on your recommendation, and can you touch on other recommendations that are separate from our committee's oversight jurisdiction?
Thank you. So quickly, because I see I'm running out of time. The first step, I do believe, is vigorous oversight, because before you can truly fix a problem, you need to know the scope and nature. But I do think that we've seen that there, and I would argue that part of the challenge to our banking regulatory paradigm is that we have regulators who are well, I don't know if they're empowered, but they certainly believe they're empowered, and they certainly feel like they're asked to engage in sort of a micromanagement view to prevent risk and to prevent banks from engaging in unsafe and unsound behavior. But the definition used is so broad that it functionally means almost anything. And while there are some areas where there is at least some objective criteria, like, say, credit risk, where if you have excessive defaults, that's an objective thing. But other things, such as reputational risk, truly becomes in the eye of the beholder. And the risk you get there is that you don't get a government of laws, you get a government of people. And that it's in the eye of the beholder of the line supervisor. And I would recommend the work of Professor Perillo, which I cite in my written testimony, to show that the dynamic where banks truly feel like they are A, bound, and B, they can't challenge it in court, which is where we get a lot of transparency normally.
Thank you. Looks like my time is up. I will yield back, but I would like to submit another question for record.
Without objection. The gentlelady's time has expired. The gentleman from California, Mr. Vargas, is now recognized for 5 minutes.
Thank you very much, Mr. Chairman. First of all, I'd like to say how pleased I am to see you as chairman. Those of us who have great respect and regard for you are very happy for you, and we wish you the best of luck. And where we can work with you, we will, and where we can't, of course, we won't. But again, congratulations to you. Well-deserved. I do want to start off by saying, I've been here for a while now myself, and when I first was here, the big issue was Dodd-Frank. My good friends on the other side used to condemn Dodd-Frank, saying how horrible it was going to be the undoing of the financial system in the United States. And then during the real stress test, during COVID, we had the bankers up here, and we asked the bankers, I actually asked the bankers, what about Dodd-Frank? Has it been helpful or not helpful? And they all said, it's been helpful. Now, to be fair to them, they didn't say they liked all aspects of it, but they said in general, especially the capital requirements, was helpful. It was helpful. It kept the industry afloat, and in fact, not only afloat, I think, Mr. Reuter, you said it, and I agree with this. I think the industry performed very well, and I think the industry was one of those shining lights in this very dark time. I think the industry did well. We could disagree about fees and some other things, but in general, I think the banking system did very well. Now, of course, the issue is the CFPB, and I hear again the demonization of the CFPB. So, Mr. Reuter, why don't I start with you? Should we disband the CFPB?
I think we should put a bipartisan Senate-confirmed oversight committee over the CFPB so it doesn't swing so greatly from administration to administration.
Okay. Should we disband it? My question to you.
I do not think we should disband the CFPB. There's been a lot of regulations moved over to that agency, but I do think an oversight board would be a great step.
Okay, fair enough. That's fair enough. I do want to comment a little bit on these ESG funds. I agree very much with Mr. Casson, of course, on this. We both now head up a committee, a caucus, I should say, on this issue. And talking about socialized benefits, it's interesting, the issue of Social Security and Medicare, I think I heard quite clearly last night that my good friends on the other side are not for doing away with both of those socialized programs, because that's what they are. I mean, those are both socialized programs, and in fact, there was an amendment that Mr. Cicilline from Rhode Island put forward to say that, you know, we were against socialism, but not against these socialized benefits, which wasn't allowed as an amendment, sadly. But anyway, when we prevent states, localities from investing in ESG funds, I think we do a great disservice to the communities there and to the people, hardworking people, especially that have the pensions. I could see why a state like Kentucky or a state like Texas wouldn't want to do that because of their industry. Obviously, they're trying to protect their industry, but that shouldn't be a reason to harm investors and especially hardworking people that have invested in their pensions. So I certainly agree with Mr. Caston. I do want to ask a couple questions if I can here, especially to you, Ms. Marcellin. The issue of MDIs and CDFIs, unfortunately in my community, we don't have a broad selection of these, and we have a lot of historically underbanked communities. What can we do in an area like my area in San Diego to help these people who are underbanked or unbanked?
Thank you, Congressman Vargas, for that question. Again, going back to my original statements, you know, one, increasing funding for the CDFI fund. Again, it has received increased funding over the years, but it is nowhere enough to fully fund and, you know, support a robust program. Even going back to CRA requirements, and, you know, I'm happy to work with your office more on this, but making sure that lending done to CDFIs by banks count as, you know, should count probably as CRA credits, and just driving more support, more programs in these communities in distressed, low to moderate income communities can help shore up CDFIs and MDIs as well.
Thank you very much. Just to conclude here, I have 20 seconds. I hope there are things that we can work on. I mean, I heard from some colleagues on the other side about suspicious activity reports and the amount that is and the burden. I agree with some of that. And I hope that there's a place that we can find a middle ground and get something done this year. Again, I congratulate you, sir, and yield back.
I thank my friend for his kind words, and the gentleman from Wisconsin now, Mr. Fitzgerald, is recognized for 5 minutes.
Thank you, Mr. Chair. For small banking markets, a community bank is often prevented from selling to a crosstown rival because of a market concentration regulation, even if it might be in the best interest of the consumers. For example, large out-of-market bank may have less interest in local institutions and market conditions. Under current law, regulators are not required to define a banking market for each bank in the United States prior to a merger request. As a result, banking markets are defined as case-by-case basis. I'm not telling anybody on the panel anything they don't know, but every time there is a proposed bank merger acquisition, it makes, obviously, banking market definitions subject to change, and it also means that some banking markets are currently undefined. Mr. Reuter, if federal regulators were to define these undefined markets, would that provide the regulatory relief benefit to banks like yours seeking a merger or an acquisition?
Congressman, I think the mergers and acquisition manual's up for revision right now. I think the definition of competition in general needs to be reassessed. Not only do you have the issues that you just mentioned, but also Fintech. Lots of activity now happens online regardless of the branch location. So in general, what defines a competitive market is much different today than when that manual was originally drafted.
Very good, thank you. While Graham Leach Bliley does not address a consumer's right to access on their own data, Section 1033 of Dodd-Frank grants consumers a right to access a portion of the data held by a covered firm related to their transactions and accounts in a usable electronic format. But again, as you probably know, it's not clear that Section 1033 extends to the agents of customers of data aggregators. Ms. Lee, how how should liability be allocated in an event where an agent, firm, or aggregator's negligence results in a breach or fraudulent transaction? Is obvious it's become very complex. I'm just wondering what your opinion on that would be.
It is a complex issue, and it's one that we have called for in our recent comments on the 1033 rulemaking that they just did, is for the supervision of data aggregators, to allow for the CFPB to have that authority to oversee and to understand. On the part of data breach, I think it depends, what we have said is not only do the aggregators be supervised, but where that breach occurs, at what point in the chain of custody of where it occurs. And so I think that we need to take a look at it when we craft these laws to determine who is the beholder of that information, where that breach occurred, and what the custodian of it is.
Very good. Mr. Knight, do you have a comment on that?
I guess one note I would say is that this is an area where, honestly, congressional involvement might be merited, because it does appear that 1033 has teed up some very difficult kind of intransient questions that are probably more appropriate for Congress to resolve rather than the CFPB. And Congress is likely in a better position to weigh trade-offs and take action. So I do think that is something that is worth consideration.
Very good. Mr. Reuter, just a quick one here. I see in your testimony that you didn't think allowing private rights of action as an enforcement tool for data privacy violations really makes much sense. Any ideas on what else could be maybe more effective than that?
I still think using the prudential regulators as the ones that supervise and take care of any enforcement actions if there's an issue is the best way to go. I also think preemption with 50 different states, I have customers in all 50 states, trying to handle something at a state level would be very difficult.
Very good.
The gentleman yields back. The gentlewoman from Massachusetts, Ms. Presley, is now recognized for 5 minutes.
Thank you, Mr. Chair. As the Congresswoman representing the Massachusetts 7th, it includes the city of Boston. It's one of the largest cities in my district. And around 10% of our households are currently unbanked, and another 20% are considered underbanked. That's over 80,000 families. So being unbanked is incredibly expensive. Unbanked people in my district are forced to pay high fees for everyday financial services, such as check cashing and money orders. And this doesn't even include the exorbitant costs of payday loans and being credit invisible. Then there's systemic closures of bank branches in low-income communities, predominantly Black and brown neighborhoods, which has really created banking deserts and exacerbated disparities. Another example of big banks really prioritizing profits over people. It's no accident that low-income communities of color in my district, such as Dorchester, East Boston, and Roxbury, consist of 57% of the city's check cashing locations, 67%, but only 12% of the city's commercial bank branches. Ms. Marceline, I know we've been talking today about solutions that Congress could enact to address, to support those that are unbanked or underbanked, and that's our job here in government, to solve problems, to alleviate and mitigate hardship. Can you describe how postal banking could be a solution and help people who are unbanked?
Absolutely. Thank you, Congresswoman Presley, for that question. So yes, Americans for Financial Reform strongly supports postal banking proposals to increase, or I should say decrease, the underbanked population. Again, going back to the things that the underbanked population usually cites, lack of trust and unable to afford a bank account. Most people, you don't hear people talking about they don't trust their post office. You may not, it may be a little cumbersome to go to, but you trust it. You know that your packages will be there. You probably have a good relationship with your post officer and with your postman and such. So that's number one. And then it has the added value of having a branch in every zip code. Secondly, if we, many of these proposals that for postal banking, it's a free account. It's basic banking services. You can, have deposits and do basic withdrawals. And it's mostly, for folks that have low income, low to moderate income. So quick and easy way to access funds. And then, as you said, not having to pay to get your own money.
Thank you. Absolutely. Our post offices are indeed, they have that shovel-ready infrastructure, since there are brick and mortar locations in every zip code, and they can provide those basic financial services like check cashing, bill payment, small dollar loans. So it could really be very transformative. Instead of people going to shady predatory lenders, they can go to their local post office. Banking deserts and exclusionary practices of financial institutions, which are real, are widening the racial wealth gap, and we need bold, intentional proposals to build an exclusive, equitable economy. This final minute, Ms. Marceline, can you elaborate on how a postal banking system would narrow the racial wealth gap?
Thank you, absolutely. So again, if you increase the number of folks that are banked, you basically give them access to the financial system. Not having a bank account, how are you, if you want to buy your home, for example, there are a lot of things that you don't have access to if you don't have the basic, it's unfortunate I have to say privilege, but basic privilege of having a bank account. You want to open a brokerage account, for example. All of these things requires being linked. Even many of the Fintech apps that are being talked today, they're being talked about today, they still require being linked to a bank account, which many low income and communities of color can't afford. So that cuts off their ability to build wealth and just gain access to the traditional financial system in many ways.
Thank you. I also wanted to just highlight legislation introduced, a bicameral bill by myself and Senator Booker, the American Opportunity Accounts Act, also known as baby bonds, which would ensure that every child is provided with a savings account at birth, would be seeded with funds that can be used for wealth-building activities such as starting a business, buying a home, pursuing higher education. Do you have any thoughts, Ms. Marceline, on our national baby bonds proposal?
Based
The
on
gentlelady's time has expired. She'll have to submit that in writing.
All right, thank you, Mr. Chair.
The gentleman from Florida, Mr. Donalds, is now recognized for 5 minutes.
Thank you, Mr. Chairman. Witnesses, thanks for being here. Really appreciate it. Chairman, I just want to first thank you for your work and your leadership in data privacy. I think that's going to be really critical for our country, for Americans. So I thank you for all your efforts. I want to touch on a couple things. And Mr. Reuter, you might be able to help me with this. So the witnesses understand I'm a recovering banker. I used to work, I got my start in commercial banking, community banking, actually. That's where I started. Went from a teller to a credit analyst. I underwrote loans. I helped small businesses get access to capital. I was in the banking industry before Dodd-Frank, before the financial collapse. And I left because I didn't want to do bank workouts, frankly. I went to work in insurance. But I remember a lot of my colleagues, some of who I hired, who stayed. And they would tell me about all the work that they had to do post Dodd-Frank. I think one of the things that has come up, not just in this hearing, but in a lot of discussions, has been the fact that there are limits of banking locations across the country. Could you speak to some of the impacts that Dodd-Frank has had on small community banks and even some sub-regional mid-sized banks?
Yeah, I think one area that's really evident is the mortgage lending business. You've seen a lot of medium and small banks exit that business due to the new regulatory requirements. We've always been a strong mortgage lender, and our mortgage portfolio performed extremely well during the financial crisis. Why? Because we're in the community. We underwrote those loans. We know the local businesses. We know their employers. So they were well-made loans. Some of the new regulations that came out of Dodd-Frank make it hard to make loans to self-employed borrowers. Lots of different parts of the regulations make it difficult to run an efficient, cost-effective business. And so some have just simply exited the mortgage business.
So let me follow up on that. If you are a small lender, I was a small lender, but the regulatory burden of Dodd-Frank just makes it prohibitively more expensive to do business. What happens when you leave a community is the community basically left to, and this is, you know, no disrespect to Bank of America or Citi, you know, they do good business, or Wells Fargo, but are the people in that community now left to larger institutions who have the capability to deal with the regulatory burden of Dodd-Frank?
Those banks do a good job on the ground with good teams, but it is different than when it's a locally headquartered bank with the ownership also in that community.
You know what, let me shift a little bit. Let me ask you about, I like to reimagine regulation. I think we're at this point in American history where we can start really rethinking the regulatory environment for the next 100 years of what the United States is going to look like. In your opinion, and Ms. Lee, Mr. Knight, Mr. Berlin, you can all chime in. What do you think the regulatory environment should look like going forward in the United States?
I think at its core, regulation is good. It's when we start adding layer upon layer upon layer and making it more complex and difficult to comply with. So I think we should always go back to what will ultimately protect consumers and help communities thrive. That should be the main motive whenever regulation is initially drawn up and amended as time goes on.
Congressman Donalds, I would say that regulators, one of the key principles that we talk about, we say the word regulate the regulators, is the regulators themselves need to be just as accountable as the businesses they regulated. That's why it is so important for the CFPB to have, you know, appropriations from Congress, given what all it does, having that direct oversight of appropriation, and not, you know, an agency should not do regulation by enforcement to come up with a rule. They should follow the Administrative Procedure Act, and ultimately Congress should be able to overturn a regulation as it is basically acts like a law, or at the very least have the Reins Act for the cost of regulation. So accountability for the regulators, I think, is a very important principle that we at the Competitive Enterprise Institute are promoting.
Well, I would agree with you. We'll see if the third branch of government will help to rein in the second branch. Ms. Lee, any your thoughts?
I would say as the technology evolves, back to Jim's point, that we do need to have that strong consumer protection, but we also need to have it fit for purpose in the sense that a lot of the technologies that are coming onto line and using it aren't fitting into a 1930 rule, aren't fitting into a 1990 rule, and we need to make sure we have proper rulemaking to oversee, to be able to address the actual risks in which these new products are doing, the services in which they're actually providing, instead of slipping them into an old rule that really doesn't apply to them and put maybe arbitrary, you know, overlay onto them, which doesn't apply to the businesses in which they're doing.
Mr. Knight, sorry, I'm out of time. Mr. Chairman, I yield back.
Gentleman's time has expired. The gentleman from California, Mr. Sherman, is now recognized for 5 minutes.
Thank you, Mr. Reuter, for mentioning the importance of having a bank where the bank is based in your city. And I'll take a moment just to bemoan the fact that Los Angeles is the largest megalopolis in this country, where most couldn't even name the largest bank actually headquartered in Los Angeles, since we don't have one befitting the size of our city. And I'll advise my colleagues that San Francisco is not a suburb of Los Angeles, much as we in Los Angeles would like to think so. It is over 400 miles away. That's further than it is from here to Boston. Back in my day, and that was many days ago, banks could make a prime +3, prime +4, even prime +5 loan. Now, that wouldn't be the whole portfolio, but that would be a chunk of the portfolio. And a local business could be their source of capital. And local small businesses have a chance of failing. Prime +5 was not an outrageous amount to charge when a business had a 5% chance of defaulting, and if there's a default, maybe you get half your money back, but you certainly don't get it all. How difficult is it for a bank to make a loan to a business that has a 5% chance of defaulting? Is it impossible under today's regulation?
It's not impossible, but it is more difficult with today's regulation, absolutely.
And we talk a lot about, we just had hearings of the subcommittee on which I'm the ranking member about getting capital to small business. The pizzeria in my district doesn't, they need a new stove. They're not looking to do a Reg D offering. They're not looking to talk to a venture capitalist. They go to the bank. And since the pizza really isn't that good, their chance of failing is 5%, and they don't get the loan. But if we can't get money to businesses that have a 5% chance of defaulting, a 5% chance of you losing half your money, you got to build in 2.5%, 3%, then small business isn't going to get funded unless your brother-in-law can come help you out. Let's see, Ms. Marcellin, we've talked a little bit about de novo banks. There are other institutions that can be helpful. How can credit unions act as a vehicle to address the unbanked and underbanked communities, both on the business and the depositor side?
Thank you, Congressman Sherman, for that question. Going back to credit unions, one of the pieces of legislation that AFR supports is the Overdraft Protection Act. We would like to see credit unions also limit how much, or actually pretty much stop their practices of charging overdraft fees and NSF fees. The same thing with minimum account balances, basically decreasing barriers to making people, especially low to moderate income folks and communities of colors, from opening a bank account. And as the name implies, a credit union, it should be a pretty low barrier.
I'd point out that if a business actually incurs costs, they've got to charge something. But some of the fees that you talked about are much higher than they should be. Mr. Reuter, I think Mr. Barr has a bill that provides relief from the first 3 years for a de novo bank from a lot of the standards on liquidity and capital. Does that pose a problem of the bank not having the liquidity that it needs to meet its obligations during its first 3 years?
I do not think it poses an issue, because it takes time for a bank to acquire customers and acquire the assets. And so to start out day one with an assumption that they're going to be much bigger in 3 to 5 years without a ramp up, I think isn't a good strategy.
I yield back.
Gentleman yields back. The gentlewoman from Texas, Mrs. De La Cruz, is now recognized for 5 minutes, and I welcome her to the committee.
Thank you. Thank you, Mr. Chairman, for holding this important hearing on how to revamp and revitalize the banking sector. And I'd like to also thank all of the witnesses for being here today and joining us to offer your insight into this area. I'm glad we are here today on this committee and Congress as a whole to update banking regulations to address emerging technologies. I am a small business owner, and I've grown my business in the good times and in the bad times. And I understand the important need for capital to help develop a business, and also for the capital to develop local communities. I'm proud to have worked with several community banks throughout my career, and want to see that they are able to remain in our communities to be helpful. I'd like to touch particularly on how to reduce barriers of entry for new banks and how to foster an environment that allows community banks to succeed. I'm increasingly worried about the fact that only 60 new banks have been formed in the past decade. And so, with that being said, specifically on local community banks, what are the needs that local community banks in particular do for the needs of local communities do for smaller local financial institutions serve that their larger regional and national counterparts do not serve? Would one of you be able to share with us?
Yes, Congressman De La Cruz. I would say that Yeah, that is a new bank not just a community bank, a new bank can fill a void, and that's why it's so important to lift the barriers to de novo bank. As an example, in my testimony of the Burden Hand Bank, which literally built horse and buggy lanes in its drive-through for the Amish community. It's very important that new businesses can in any industry can fill a void, and in banking and financial services as well. And that's why Chairman Barr's bill and Congressman Auchincloss's bill is encouraging de novos and lifting the regulatory barriers to them are so important.
And may I ask, how are they different than a regional or national counterpart? What can they do differently than the national counterpart?
Well, ultimately, it's up to them to demonstrate, but just consumers should be given a choice that if they like the services better in a community bank than a regional or national counterpart, they should have that choice. And the FDIC and other regulatory agencies should certainly lift the unnecessary barriers. And Congress should look at lifting the unnecessary barriers as far that prevents them from thriving and giving consumers more of that competition and choice.
Representative, may I speak to your question?
Yes, sir.
So at least historically, the advantage that community banks have had is what's called soft information, right? It's been referenced earlier that, we know you, we know your employer, we know the community, we understand. Whereas by necessity, like a large national bank is going to rely more on metrics. And I'm not trying to denigrate metrics, and there's a live debate about which is better. But my understanding is that one of the effects of regulation has been to chill the use of soft information, because if loans go bad, it's harder to satisfy your supervisor to say, well, we knew them and we thought they were a good risk. Whereas if you can point to a metric and be like, look, there's this line, the line was above the other line, what do you want from me? It's easier to satisfy regulatory scrutiny. And so to the extent that we are disincentivizing soft information and local information, that is going to, place community banks at something of a disadvantage because they're less able to use advanced analytics, but two, creates the risk that worthwhile customers whose metrics don't necessarily look good might be frozen out. Now I should reference in my written testimony, this is an area where non-bank technology firms do seem to be helping in some degree by using sort of non-traditional metrics or using metrics in new ways. But I don't want to say that that is a substitute for that on-the-ground, rooted knowledge that a community bank can provide.
Thank you. I yield back.
The gentlelady yields back. The gentleman from Tennessee, Mr. Ogles, is now recognized for 5 minutes, and I'll welcome him to the committee.
Thank you, Mr. Chairman, esteemed guests. You mentioned in preparation for this hearing, and so when I think about the industry, the sea of regulation, the complex matrix that makes up the banking sector, I'm curious, yes or no, when you look at the cost of regulation, the cost of compliance, fines levied by out-of-control agencies, are those costs passed on to the consumer? Yes or no, Mr. Berlow?
They certainly are. I mean, one of the examples I had was the Durbin Amendment, where basically you capped what big retailers, are paying banks and credit unions to process debit cards, and that resulted almost immediately in some of the end of free checking, and may have resulted, according to scholars from George Mason University, in 1 million unbanked. So that was one of the most promised examples, Dodd-Frank Section 1075, but there are lots of other examples as well.
Thank you. Mr. Knight, yes or no?
Is it reasonable to expect this cost would be passed on to either consumers, investors, or both?
That's right. Ms. Lee?
It depends on the products and services, but I would say yes in certain cases.
Mr. Reuter?
Yes.
Yeah. So at Koch Industries, there's a management philosophy, market-based management, now called principle-based management. Within that construct, you have creative destruction, where you're talking about a sector or an industry or even a business. If they're not constantly innovating, evolving, adapting to the marketplace, that they become obsolete. So you think of a Kodak or an IBM that once were powerhouses in their sector, but they were pushed out. They were displaced by new industry and innovation. So you're before this committee, and you're seeking assistance, let's say, and you have one bite at the apple, one request for us to take action, whether it's a regulation that needs to be stricken, a code that needs to be modified, or quite frankly, an agency that needs to be defanged, that's going to allow competition, that's going to spur innovation in the marketplace, that in essence will create this creative destruction that we need to see in the banking industry and current technologies? Yes, sir.
I would say Chairman Barr's de novo bank bill, along with the Auchincloss bill, which I think goes along with it, that would basically force the FDIC to go toward more of a system of phased-in capital, but more importantly, sort of give a yay or nay. Give if they disapprove an applications, what are the reasons for it, but have a time limit. Encouraging new banks, I think, is one of the best things we could do, and it's also someplace where it shows, having the two bills there and having bipartisan co-sponsorship on it. Last year, where there actually is sort of somewhat of a consensus emerging that we need new banks and get rid of barriers to them.
Thank you. Mr. Nye.
Restrict bank regulator authority over non-objective criteria and move to a more objective system for bank regulation to avoid some of the abuses I referenced in my written testimony.
Thank you, sir. Ms. Lee.
The promulgation of Rule 1033, which is an open banking rule, which will allow consumers to be able to share their financial data with the technology services that are out there so that they can have personalized banking in a way that fits them best.
Mr. Reuter.
I would second what Mr. Knight said, regulatory certainty, ensuring that the leads of the regulatory agencies enforce the existing laws rather than create new ones or interpret.
Thank you all, Mr. Chairman. I yield back my time.
Gentleman yields back, and the gentleman from South Carolina, Mr. Timmons, is now recognized.
My apologies. Mr. Reuter, what are the economic effects on communities, urban, rural, and otherwise, of such a steep decline in formation of new local financial institutions, and what are the effects on both individuals and small businesses?
The lack of de novo charters, no doubt, hurts communities. One of the questions asked earlier was, what's the difference between a large bank or regional bank and a de novo community bank? The congressman from California mentioned earlier, when a bank would start, it'd have local investors. And so when you have your primary shareholders, your initial investors in the community, it just makes a difference on what that bank can do. Our banking industry needs the very large. They handle things we can't handle, but we also need smaller banks to have a robust community.
Thank you. What has been the impact of consolidation and less competition, particularly as it relates to the drop-off in formation of new local financial institutions on depositors and on borrowers?
The consolidation has to happen. I mean, it has to be allowed in order for banks to handle the communication or the IT costs, increased compliance costs. But at the same time, we need new startups. I mentioned earlier, Apple started as a small company. There's a new Apple that started today somewhere out there in the technology world. Banking, we need the same thing. JP Morgan Chase does amazing things, but we need the new version of JP Morgan Chase starting in a community.
Do you think that it has to be a physical presence, or could it be technology, app-based?
It could be technology app-based or a physical presence. Depends on the needs of the community and the strategy of that bank.
Thank you. I'll stick with you. One more question. A core principle on which we can all agree is that consumers should understand the pieces of their data that are being collected and how that data is being used. But as we know, most consumers do not read the pages and pages of fine print that are provided when we sign up for a new product or service. We also know how annoying it can be to click accept cookies on every new website we open. Would you talk a little bit about how to thread the needle of making sure consumers are informed about terms and conditions in a way that provides them with a meaningful understanding of these terms and conditions?
I think the Gramm-Leach-Bliley Act, while it is 20 years old and needs updating, has stood the test of time and working well for banking, where we have to disclose to a customer if we're going to share their data with an unaffiliated party, and they have an option to opt out of that. I think it's worked very well for our industry.
Would you agree that technology, cybersecurity, just general internet platforms create a challenge for smaller banks that don't have the bandwidth to manage those challenges?
Absolutely. That is an additional cost to doing business.
Do you have any thoughts of how that could be mitigated through maybe some streamlined regulation to give the smaller banks a chance to not be to compete?
Absolutely. Tailoring of regulation is really important, and we've seen examples of that throughout history, and it's important going forward. The risks and the complexities of a community bank are much different than that of a larger institution, so regulation should make sense based on the size of the bank.
Sure. Ms. Lee, a question for you. I know we've touched on this before, but a topic that's front of mind right now is the concept of data portability. Would you discuss what that term means and how it can serve as a benefit to consumers?
Sure, and good to see you again. In the term of data portability, it is the ability for the consumer who should be able to control their financial data, where it goes, what services that they will be sending it to, the applications in which they can interact with. So it's the notion that, for example, if they want to, get a small business loan, that they have access to their cash flow, that they have a full understanding of who they are as a consumer and are able to share that and get a very competitive loan, whether it be online at their community bank or other services. And so it gives them the ability to personalize what the financial services they want to choose with, interact with, and be a part of to be able to have a fuller financial life.
And there's also value to that data to different parties. Could you speak of the ways that data is monetized?
I can speak only for our member companies, and they do not monetize off financial data. They keep it comported to kind of the delivery of service, whether that means if they use a buy now, pay later to actually fulfill the order, or if they're using it to complete the transaction on the app in which they are. So ours do not monetize off the data.
Sure, thank you. Mr. Chairman, now you're back.
Thank you very much, and I thank all of our witnesses for the outstanding testimony, everyone's participation, and the members' questions today. I think we learned a lot about the value of community financial institutions and the innovation happening in Fintech. We learned that streamlined regulations, whether it's data privacy or whether it's safety and soundness, consumer protection, that tailored regulation and regulation that enables the private sector to continue to innovate, serves customers, protects customers the best, and makes sure that businesses and families have access to capital. I would just note for the record that while members may continue to insert bills into the record, they are not officially attached to this hearing per our committee rules, specifically Rule 3D1B. I encourage my colleagues to work with us going forward to ensure that all bills are noticed appropriately. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witness for their response. I ask our witnesses to please respond as promptly as you are able if that actually occurs. This hearing is now adjourned.